Okay, here we go again. The video shot will be shown in the new room right now. Guys, I assume you can hear me and you can see my voice. Sorry for that upset. We had two mics on at the same time from different traders. You new guys, can you just type Y if you can hear me as well and if you can see the screen, and then I'll get cracking. Good job. So sorry about that technical glitch. We're back on track. Wednesday the 4th of August, now 12:44, 1:45. I'll try and make this relatively brief as we're running a bit behind today. I was mentioning that yesterday on the macro and microeconomic front the data was bad, the news was bad, and this was just after the market the day before. I was getting excited as the market had a consistent and momentum trend. You saw that we rose really from around the levels of 1090 all the way up to 1124.25. Lovely move in the E-mini S&P, which I was hoping would get us out of the doldrums. The doldrums of the range that we've seen over the last few months. We've had this range continuing really since the middle of May, and yesterday was exciting news as we had a consistent and sustained trend. That, however, completely taken back by yesterday's bad data. Any positive sentiment that there was in the market then transferred to this sideways movement, and I've got the whole of yesterday really transferred in this red box. You can see the day starting really on a high, trying to continue the rally beforehand, then moving sideways to slightly lower and grinding lower. So a pretty bad day for the markets yesterday on the data front and also on the sentiment front. It was just at a time where we thought we'd managed to get enough momentum and enough positive consumer sentiment out there to take the stocks higher. So what happened? Well, Procter & Gamble, they were terrible. Housing data was bad yesterday. Factory orders, Red Book, all bad. Really negative on the macroeconomic front, as we've been expecting. And that has an effect for the dollar, and I'm going to share with you a chart of the dollar-yen that we've been looking at recently, and here it is. This is the value of the dollar against the yen, and you can see really from the middle of April, it's a one-way street. Serious devaluing of the dollar against the yen. This not helped by the fact Ben Bernanke comes out with comments such as on July the 21st saying that the US outlook remains unusually uncertain. Policymakers to consider on August the 10th whether to use cash received from the Fed's maturing mortgage bonds to buy new mortgages or treasury bonds. Very, very dovish comments coming out of Bernanke last time, and of course we're looking forward to him speaking again this week. This was actually the yen gained against all 16 major counterparts yesterday, but mostly for the dollar, which represents fear in the markets. The markets are scared at the moment, guys. There's something going on. The assumption that we'll have a gradual and gentle grind higher in equity markets worldwide is being put into question, and nowhere more so by long-term government debt. I'm sharing with you a chart of the Bund here now. I was talking about the Bund yesterday with you guys. I couldn't believe it, because this was when stocks were moving higher and actually gaining some ground after the bad data. Government debt was also moving higher, and normally there's a inverse relationship between these two asset classes. At the moment they're going the same way, and what does that tell me? Well, it tells me that these two asset classes are predicting a different future at the moment. There's a disagreement in where this economy is heading. If you look at government debt, they're saying double dip. They're saying this market is not out the doldrums yet, unemployment is high, house prices are low, there's a lot of uncertainty out there, and the governments have overextended themselves. That's what you get when you look at the picture of the Bund. Conversely, if you wanted to look at a long-term picture of the DAX, for example, you've got this chop zone really since May, but generally grinding higher, okay, and it's got its head above this 629 level. It's certainly not predicting an absolute disaster that the government debt is. The stock indices, the DAX and the E-mini S&P are predicting a gradual and slight recovery, perhaps with lack of strong momentum, but certainly not predicting a disaster. So there's a definite divergence in valuations and future predictions going on between the asset classes, and I think that kind of scenario has given us these choppy conditions in the E-mini S&P. Let's talk about yields and bonds a little bit further, guys. For the first time in 7 years, Japanese 10-year bonds last night went below 1%. Super cheap, super reliable, as demand for Japanese debt going through the roof. Safe haven, a secure asset. Now, This is an odd scenario when you look at Japan, when you see actually the Japanese economy is not that fantastic. Why is it that the rates they can offer on their bonds is so low? In fact, in many ways you could say Japan and Greece have similar aspects. Their economy is very, very slow growing. They've got a problem with inflation and high unemployment. Well, the three key differences are Japan owes money to itself, Greece owes money to the rest of the world. Japan's maturity on its debt is double that on Greece. Greece will have to service its debt in half the time that Japan needs to service its bonds. Okay, also, Japan has its own control, has its own sovereignty over its monetary policy. If Japan wants to change something, Japan can change something. Greece is under the whim, under the control of a dysfunctional, archaic and, in my opinion, quite useless monetary union that makes its decisions for it. Greece has no control over what it's going to do. The ECB will tell Greece what to do, and that's why Greece's yield remains above 10% and Japanese yields remain below 1%, whereas on the face of it you'd see they've got relatively equivalent economic scenarios. So the Bund, I've talked about the Bund. I mean, that's saying that, look, the economy is pretty much dead in the water at this point when you look at the Bund alone. What's our strategy for today? Well, the similar levels actually to what we were using yesterday. Andrea has on the E-mini S&P. I've got the line on the chart here for 11.13 as an entry point long. We've got the target pretty much as the top of the range. Alejandro's typing that I love the EU in the room. Alejandro, it's the opposite. So we're looking for a conservative trade today, really. I mean, the main data to watch today is the ISM and the ADP are coming out of the US. As you know, the ADP being a precursor to the non-farm payrolls figure on Friday. I'll talk about that in a bit. What about the euro? Well, we absolutely nailed the euro yesterday, as you guys would have seen, and again we're looking for a long entry $1.31.83, conservative exit $1.32.62. Please apply these lines to your charts as well. They're on Andrea's analysis. Oil, guys, following our consistent strategy with long asset classes across the board, long 81.37 with an exit looking at 82.82. Now we hit that obviously at the end of yesterday or mid yesterday. We didn't quite get there this morning. Then it may be another opportunity. We believe the equity markets are right and not the bond markets as yet. We believe that over time, over the next few weeks, over the slow month in August, these equity markets will grind higher and the bond markets will adjust, but there is so much uncertainty out there. The slightest bit of bad news, bonds go through the roof. Speaking about bad news, and other news, guys, I don't know if you saw this morning, but Iranian President Mahmoud Ahmadinejad survived an attack made with homemade explosive device outside his motorcade during a visit to the western city. Oil market didn't react at all. Really, I mean, when you get news like this, you know, traders will wait, assess it. People are just waiting to see about this. Is it significant? You could, if it's just some random nutter's attack on a president that he doesn't agree with and there's actually no result of this, then there'll be no reaction in the oil price. But, well, the BBC Taras is saying there it was a firecracker now. Is that the latest? Wow. Okay, well, good job. No one went mad buying oil off that. If someone did try and assassinate Ahmadinejad and got caught, then I wouldn't imagine he's in for a nice couple of years ahead, to be honest. I've mentioned the data ahead, so what have we got? US ISM. That's going to be important. It's all really about the service sector. How is growth? How is the economy faring? And with the market so nervous, you know, constantly applying a thermometer to the economy is being eagerly watched by traders just so they get a bit more information. Can we hold on to these gains? We've also got ADP, guys, and as you know, this is a bit of a lagging indicator. It's not actually that accurate in relation to non-farm payrolls. In fact, in May it might show that payrolls rose by 30,000 in July after increasing by 13 only in June. So we'll keep an eye on the ADP, but I think as the huge amount of volatility and uncertainty remains in the economy, as you've seen, these economic figures get revised and then revised and then revised again, which means, unfortunately, from our point of view as intraday traders, they lack their credibility when they do come out. So you don't get those nice clean moves off a divergence in economic data that you could have done. You saw that reply with the UK GDP figures coming out and being met with huge amount of skepticism, so that everyone just says they'll be revised in a month's time. So that's unfortunate for us. Let's hope we can stay above these levels. An entry point, I think, on the S&P of 11.30